If you have a traditional IRA or a 401k, the IRS eventually forces you to take money out whether you want to or not. These are called Required Minimum Distributions, RMDs. Most people know that much. What most people don't know, Secure 2.0 changed the rules in ways that affect how much you withdraw, when you start, what happens if you miss a distribution, and whether your heirs inherit a tax time bomb or a clean account. Several of those changes only finalized in the last 12 months. In this video, I'm going to walk through everything that changed, how to calculate your exact RMD for 2026, the 5 most expensive mistakes people make, and 3 tax strategies that can legally reduce what the IRS takes from your withdrawals. If you or someone you know is 70 or older, or is the beneficiary of an inherited IRA, this applies directly. Here's what we're covering today: the new RMD starting age under Secure 2.0 and who it affects, which accounts are now permanently exempt from RMDs, how to calculate your exact 2026 RMD using the IRS Uniform Lifetime Table, the 5 mistakes that trigger penalties, the inherited IRA rules that changed in January 2025, and 3 legal strategies to reduce your tax bill on RMDs. Let's start with the basics, because the basics changed. The most important change Secure 2.0 made to RMDs is the starting age. Before 2020, RMDs started at 70.5. Secure 1.0 raised that to 72. Secure 2.0, passed in December 2022, raised it again. Here's the current schedule. If you were born between 1951 and 1959, your RMD starting age is 73. You are in the window right now. If you were born in 1960 or later, your RMD starting age is 75. That change takes effect in 2033, so if you're 65 today, you have a decade before your first RMD is required. These later start dates matter because every additional year you don't have to take a distribution is a year your account compounds tax-deferred. For someone with a $1 million traditional IRA growing at 7%, that 2-year delay from 72 to 73 is worth roughly $70,000 in additional untouched growth before the IRS starts its clock. Now, who actually has to take an RMD in 2026? If you are 73 or older in 2026 and you own a traditional IRA, SEP IRA, Simple IRA, 401k, 403b, or governmental 457b plan, you are required to take a distribution by December 31st, 2026. If you're turning 73 in 2026, you have one additional option. You can delay your very first RMD until April 1st, 2027. I'll explain in a few minutes why doing this is usually a mistake. Here's one of the most underreported changes from Secure 2.0. As of January 1st, 2024, Roth accounts inside employer plans, Roth 401ks, Roth 403bs, Roth 457bs, are no longer subject to required minimum distributions during your lifetime. Before that date, Roth 401ks had RMDs. A lot of people don't realize that. Roth IRAs never had them, but the Roth option inside your workplace retirement plan did. That asymmetry is gone. This means if you have a Roth 401k and you were previously taking RMDs from it, you no longer have to. Your Roth 401k balance can now compound indefinitely without any forced withdrawal. The accounts that are still fully subject to RMDs in 2026, traditional IRA, SEPI IRA, Simple IRA, traditional 401k, traditional 403b, traditional 457b, every dollar you've ever deferred on a pre-tax basis has an IRS deadline attached to it. That deadline is now just later than it used to be. The formula for calculating your RMD is straightforward. You take your account balance as of December 31st of the prior year, in this case December 31st, 2025, and you divide it by a life expectancy factor from the IRS Uniform Lifetime Table. Here are the key factors for 2026. If you're 73, your factor is 26.5. If you're 75, your factor is 24.6. If you're 80, your factor is 20.2. So if you have a $500,000 traditional IRA and you're 73, your 2026 RMD is $500,000 divided by 26.5, which is $18,868. At 80, the same $500,000 balance produces an RMD of $24,752. As you age, your factor shrinks, and your required withdrawal increases as a percentage of your account. The IRS is designing this to ensure the account is substantially depleted over your statistical lifetime. One exception to the standard table: if your spouse is the sole beneficiary of your IRA and is more than 10 years younger than you, you use the joint life and last survivor table instead. That table has lower factors, which means a smaller RMD each year. If you have multiple traditional IRAs, you calculate the RMD for each one separately using its December 31st balance, but you can withdraw the combined total from any one or any combination of IRAs you choose. The calculation is per account. The distribution can be aggregated across IRAs. Employer plans, 401ks, 403bs do not aggregate with IRAs. Each employer plan has its own RMD that must be satisfied separately. You cannot take an extra IRA withdrawal to cover your 401k RMD. Under the old rules, missing an RMD triggered a 50% penalty on the amount you should have withdrawn. It was one of the harshest penalties in the tax code. Secure 2.0 cut that in half. The penalty is now 25% of the missed distribution. And if you catch the mistake and correct it within 2 years, meaning you actually take the distribution you missed, the penalty drops further to 10%. The IRS also has discretion to waive the penalty entirely if you can demonstrate reasonable cause and you took corrective action promptly. This is still a significant penalty. A $20,000 missed RMD costs you $5,000 at the 25% rate, or $2,000 if corrected within 2 years. But it's meaningfully less punitive than the old law, and the 2-year correction window is new. If you've recently discovered a missed RMD, perhaps you just found out about the rule, or a plan administrator made an error, file IRS Form 5329, attach a letter explaining the situation, and take the missed distribution immediately. The IRS routinely waives the penalty for first-time mistakes when the correction is prompt and documented. Here is one of the most expensive RMD planning mistakes, and it happens to people in the first year they're required to take a distribution. When you turn 73, you have 2 options for when to take your very first RMD. Option 1, take it by December 31st of the year you turn 73. Option 2, delay it until April 1st of the following year. That April 1st option sounds appealing. 1 more year of tax deferral. But here's the problem. Delaying your first RMD doesn't eliminate the second one. Your 2026 RMD, if you delay it to April 1st, 2027, is due April 1st, 2027. Your 2027 RMD is also due December 31st, 2027. That means in calendar year 2027, you're taking 2 full RMDs. 2 RMDs in 1 year can push you into a higher tax bracket, trigger Medicare premium surcharges through RMD, the income-related monthly adjustment amount, and increase the percentage of your Social Security income that gets taxed. The math usually favors taking your first RMD in the year you turn 73, before December 31st, so you spread 2 years of income across 2 calendar years instead of compressing them into one. The only scenario where delaying makes sense: if you expect significantly lower income in the following year, perhaps you're retiring mid-year, or you have an unusual one-time income event in your RMD year. In most cases, though, take the distribution on time. If you've inherited an IRA from someone other than your spouse, the rules that apply to you changed dramatically under Secure 1.0 in 2020, and then changed again when the IRS finalized regulations in January 2025. A lot of people are still operating under the wrong rules. Here's the framework. Most non-spouse beneficiaries, adult children, siblings, friends, are subject to what's called the 10-year rule. You must fully deplete the inherited IRA by December 31st of the 10th year following the original owner's death. There is no annual RMD requirement during those 10 years. You can take as much or as little as you want in any given year, as long as the account is empty by year 10. But, and this is the part that January 2025 IRS regulations clarified, if the original account owner had already started taking their own RMDs before they died, the rules for beneficiaries are more restrictive. You must take annual RMDs in years 1 through 9 based on your own life expectancy and then fully deplete the account by year 10. If the owner died before reaching their required beginning date, before age 73, you have more flexibility. No annual RMDs are required, just the year 10 full depletion. Who is exempt from the 10-year rule entirely? 5 categories of what the IRS calls eligible designated beneficiaries: surviving spouses, minor children of the account owner until age 21, then the 10-year clock starts, disabled individuals, chronically ill individuals, and anyone less than 10 years younger than the original account owner. If you're a surviving spouse, you have the most flexibility. You can roll the inherited IRA into your own IRA and treat it as your own, delaying your own RMD start age. If you inherited an IRA and you're not sure which rules apply to you, the determining factors are your relationship to the deceased, whether the deceased had started RMDs, and when the inheritance occurred. This is one area where getting advice from a tax professional or financial advisor is worth the cost. Here is the most powerful legal tool for reducing the tax burden on your RMDs, and it's one of the most underused. It's called a Qualified Charitable Distribution, or QCD. Here's how it works. If you're 70 and a half or older, you can direct money from your traditional IRA straight to a qualified charity, up to $111,000 per person in 2026, or $222,000 for a married couple. That amount counts toward your RMD for the year, and here's the key: it never shows up in your taxable income. A regular charitable donation gives you a deduction, but only if you itemize and only if it exceeds the standard deduction threshold. A QCD excludes the entire amount from your adjusted gross income. That's a direct reduction, not a deduction. The difference matters because your AGI drives 3 other expensive calculations: your Medicare Part B and Part 500 premiums through IMA, the percentage of your Social Security benefits that gets taxed, and your eligibility for certain ACA marketplace subsidies. Let me put a number on this. If your RMD is $20,000 and you donate $10,000 of it as a QCD, only $10,000 shows up as income on your tax return. If you're in the 22% bracket, that's $2,200 saved, plus potential IRMA savings of $594 to over $4,000 per year, depending on your income bracket, plus potential Social Security savings. The QCD can cascade into multiple separate tax savings simultaneously. The rules: the distribution must go directly from the IRA to the charity. You cannot receive the check yourself and then donate it. The charity must be a 501c3. Donor-advised funds do not qualify. If you give to charity regularly and you have traditional IRA assets subject to RMDs, a QCD should almost certainly be part of your annual tax planning. Let me compress the most expensive errors into 5 that come up repeatedly. Mistake 1: taking your 401k RMD from your IRA. IRAs can be aggregated. You calculate each IRA's RMD separately and withdraw the combined total from any of your IRAs. But that rule does not extend to employer plans. Your 401k RMD must come from your 401k. Your 403b RMD must come from your 403b. You cannot cross-satisfy them with IRA withdrawals. Mistake 2: forgetting the year of death RMD. If someone dies after their required beginning date and had not yet taken their RMD for that year, the beneficiary must take that distribution. It doesn't disappear when the account owner dies. Missing this triggers the penalty against the estate or beneficiary. Mistake 3. Waiting until December 31st. The brokerage needs time to process the distribution. If you call on December 30th and the funds don't clear until January 2nd, you've missed your deadline. Build in a week of buffer. December 15th is a practical target for year-end RMDs. Mistake 4. Forgetting a small or old account. A lot of people consolidate most of their retirement savings into 1 or 2 accounts, but forget about an old IRA at a prior employer's custodian or a small CP IRA from freelance income 15 years ago. Every account subject to RMD rules requires its own calculation. Log into every retirement account you hold and confirm its December 31st balance is accounted for. Mistake 5. Not updating your beneficiary designations after the 10-year rule change. The inherited IRA rules are fundamentally different from what they were before 2020. If your estate plan was designed around the old stretch IRA strategy, which allowed non-spouse beneficiaries to take small distributions over their entire lifetime, that strategy no longer works for most beneficiaries. Review your plan. The most effective long-term tool for reducing future RMD burden is converting pre-tax IRA or 401k assets to Roth before you hit RMD age. Here's the logic. Every dollar you convert from a traditional IRA to a Roth IRA is a dollar that will never generate an RMD. It grows tax-free and can be passed to heirs tax-free. The conversion itself is taxable in the year you do it. But if you execute it strategically, in years when your income is lower than it will be during retirement, you're locking in a lower tax rate now. The ideal window for Roth conversions is the gap between when you retire and when your RMDs begin. If you retire at 65 and your RMDs don't start until 73, you have up to 8 years of potentially lower income. During those years, fill your lower tax brackets with Roth conversions. The math. If you're married filing jointly in 2026, the 22% bracket tops out at $201,050 of taxable income. If your income in a given year is $120,000 from pensions and Social Security, you have roughly $80,000 of 22% bracket space available. Converting $80,000 of traditional IRA to Roth locks in the 22% rate and permanently removes that $80,000 plus all its future growth from your RMD calculation. Done consistently over 5 to 8 years, this strategy can cut your future annual RMD by 30 to 50%, which also cuts the associated RMA exposure and Social Security taxation. Here's your 2026 RMD action list. 1. Confirm your RMD starting age. Born 1951 through 1959, your start age is 73. Born 1960 or later, your start age is 75, effective 2033. If you turn 73 in 2026, you have an RMD due by December 31st. 2. Gather every December 31st, 2025 account balance for every pre-tax retirement account you hold. Traditional IRAs, SEP ERAs, simple IRAs, 401ks, 403bs, every account. 3. Calculate your RMD using the Uniform Lifetime Table. Divide each account's December 31st, 2025 balance by your age factor. At 73, that's 26.5. At 75, it's 24.6. At 80, it's 20.2. 4. If you're charitably inclined, arrange your QCD before December 31st. Direct the transfer from your IRA custodian to the charity. Do not receive the funds yourself first. 5. If you're between 60 and 72, model a Roth conversion strategy now. Every year you wait reduces the runway you have to shrink your future RMD base before the forced withdrawals begin. 6. If you've inherited an IRA, confirm which rules apply. 10-year rule with or without annual RMDs based on when the owner died relative to their required beginning date. If in doubt, consult a tax professional. Required minimum distributions are not optional, and the rules around them are more nuanced now than they've ever been. Secure 2.0 gave retirees more time, reduced penalties for mistakes, and eliminated RMDs on Roth 401 case, but it also tightened the rules on inherited IRAs in ways that are still catching people off guard in 2026. The key takeaways: know your start age, calculate your RMD from every applicable account, don't delay your first distribution into a double RMD year, use QCDs if you give to charity, and if you haven't yet hit RMD age, use the remaining time to convert strategically into Roth. If you want to go deeper on the Roth conversion strategy specifically, including how to model the break-even year and avoid converting too much in any single year, that video is linked here. It's the direct companion to this one. This video is for educational purposes only and is not investment or tax advice. RMD rules are complex and individual situations vary. Consult a qualified tax professional or financial advisor before making decisions about your retirement distributions. If this was useful, subscribe. We publish this analysis every week. I'll see you in the next one.